So we want to be familiar with it. And so that's why we're doing it. So Anthony, let's start the show and let's get cracking.
All right, guys. Those of you that do not know who I am, Anthony Angelillo, branch manager over here with Paramount Residential Mortgage Group in Miami Shores, also CEO, founder of Tag Team Nation Marketing Company, and partner for DC Consultants, co-host with Damage Control, Melinda Grimaldi. Doing this business now for going on 19 years, I want to say, and it was nice, man. I got a call this morning from a gentleman who is subscribed to DC. With a really complex loan scenario that I'll go into in detail later down this little rabbit hole that we're about to go into. But it was awesome for him to say, look, you guys are pushing out good content. And even through COVID, those of you that attended through COVID, it was nice for him to validate the fact that we're really helping a lot of agents out, and the material that we're producing is for you guys. And he made me laugh because Melinda's gonna like this. He's like, so is it a full-time job? I'm like, yeah, buddy, it's a full-time job. So it's difficult, but it's awesome, man. And I wouldn't have it any other way. And I'm proud to be a co-host with Melinda. And at that, I'll let her introduce herself.
Hi guys, Melinda Grimaldi, real estate title attorney, Grimaldi Law Firm, and the Closers Title Insurance Company. So, I picked this topic because I think that most agents need it. And I wanted a refresher anyways, because we just had a scenario last week where we closed, but the buyer's agent negotiated a big chunky credit at closing due to inspections. And at the end, we weren't able to use all the credit, at least initially, because of the loan type. And this was known from the beginning. So we could have addressed this from the beginning. The lender didn't bring it up, and all these things. So the refresher is good for everybody so that we're not scrambling at the last minute for things like this. And we set up the file right from the beginning. Now, a little hack. Basically, the closing costs were not high enough to match that number. So what we did is increase the closing cost by prepaying a few months of maintenance fees, and it worked, and we got it through, and the buyers got their full access to the credit, which they were happy about. I was happy that we finagled the system. That's the creativity. Like, how can we increase closing costs? Unfortunately, they prepaid their insurance. So that took some, that was an issue there that we shouldn't have had. But in any event, we got it done. So that's kind of what triggered. I'm like, I really think we need this episode to go over the different loan types, because the different loan types really impact the type of property you can pick with regards to property conditions. It impacts if it can be done, if it's a condo or not. It impacts how much down payment is needed. It impacts how much seller concessions can be had. So those are some biggies. Those are some big, they sound like they're a very small portion of the process, but they can make or break the process if not done properly. So I asked Anthony, he has this beautiful chart. And so we're just going to talk about it today. And then you guys will get the chart if you're subscribed, so that you could have it as a reference to be able to, before you go in and negotiate things, have that information. Before you set up this offer, have that information. And as a listing agent, understanding the loan types, then when those offers come in, like, yeah, this might not even work because of the property conditions or the type of condo you have, et cetera. So, and then
the other thing too is I know a lot of people are watching later today or right now live. We know we're in a seller's market, and we understand that a seller's concession is probably not going to happen right now, but I am seeing a lot of inspections go sour, and there's a lot of things that need to be adjusted. And so they are giving back money, and the seller is contributing back XYZ to change the electrical panel or this or that, or whatever the case may be, to make sure it's compliant, Fannie Mae or Ginnie Mae. But at the end of the day, there are concessions given. And that's why we want to do this topic too. And then even prior to COVID, it was a seller's concession. And I was the king for that, to get, concessions towards closing costs. And I still do that a lot with listing agents when I'm, corresponding with a buyer's agent. So it's a good topic. we'll try to make it fun because I know mortgages are like, blah.
Wah, wah. The only thing worse than talking about mortgages is talking about like contracts and title. It's not sexy, guys, right? We know. Our best attended events and trainings, whether live or in person, are always about how to grow your business, about marketing, about sales. But the reality is, improving your craft as a professional is so important. And it's part of your repertoire in your marketing, and that you're always learning. And you should be talking about how you're taking more classes and improving your skills, because that's how you have that. On top of that, that's how you get the confidence as a realtor to go out there and get the business, right? So it's also the psychological aspect of knowing that I we get calls all the time from agents not sure
Really?
about things, about anything, right? And not sure about, oh, what do I do on this contract? What do I do on this loan? What do I do with this, right, Anthony? I'm sure you get called all the time, like, how does it work?
I mean, I just got that this morning.
Right. So the reason
Literally just this morning, can we do 10% down on a condo? I thought it was 25%. It's good that she said that to me. I'm like, good, it's working, but it's not 25%, guys. Let me just be clear with that. You can do less than 25%. You can do 3% if you're a first-time home buyer. If the complex is approved, you do not want to gamble with condos that are not going to be stable. If they're solvent and they're non-warrantable, I'm not touching that, man. And I wouldn't think you guys should either. So now it's questions like that we receive every day, and sellers concessions and things of that nature. That's a lot of, we get those questions all the time, and there's caps on that, which we'll go into. The
so
chart.
let's not squirrel.
All right, let's do this.
Let's scroll back. We're doing this so you guys obviously take better care of your clients, have your files in order, feel more confident. So we're going to go through and talk about the different loan types.
Yeah.
And within the loan types, we're going to talk about down payment, concessions, and a few other things. So let's just talk about VAs to start. I think it's a good place to start because I think this has the most misconceptions. So the VA loan, they can put 0% down, right, Anthony?
It's 0% down, and they can put whatever percentage they want to put down. If they want to put 20%, they could do that. I wouldn't suggest liquidation of money, but they could do that to lower their monthly payment. Absolutely.
Excellent. So is there a cap on seller concessions? I believe that there is, per your chart, 4%. So what about I know there's property condition requirements, right? I know that for a VA closing, they got to do wood, like a termite inspection, which is wood destroying organism, WDO inspection, right? So there can't be evidence of active termites on the property. What if there's previous termite damage? How does that impact, or does it impact at all?
I mean, if there's previous, the report's gonna show it was previous, and they're non-existent, and you're kosher. So
Okay.
if you say that they're gonna need to be treated, then obviously that's something that underwriters are gonna pick up and stip for. So
Gotcha. So then there'll be a stipulation that it needs to be treated. So that'll have to be done before closing. Proof certificate will have to be submitted that it's been completed, right?
yeah.
Okay, cool. What about the four walls? Like, is there roof requirements, other than the termites? Like, what else is there that's a requirement for the VA?
Same thing as HUD. So HUD governs obviously FHA. They want if there's a pool, there needs to be a fence in around the pool. If there's windows, they're gonna make sure there's no cracks or holes in the screens. If there's bars on the window, those need to be removed. Fire hazard. If there's not a 4-burner stove, that's a problem. There could be no appliances, but they're going to want to see a stove. If there's code violations and the garage is turned into an illegal room, then obviously that needs to be fixed. But if it doesn't add value to the property, then it sometimes can slide. It depends. Is there a step to get into that room? There's a lot of variables. That's another hour conversation that we could have with that.
So I think that's a great cheat sheet about property HUD conditions. Just saying.
Just thinking that. Hold on.
I think you should do that, and that should definitely be dispersed to our like talking about like windows, walls, roof, you know, et cetera, et cetera. I think that's a great cheat sheet because people ask that all the time.
And,
So
and it's
that,
not, they don't ask, they do ask it, but what I'm saying there is that I think listing agents list it incorrectly. Oh, we only need conventional. Why? Let me look at the pictures because, you know, there's a couple tiles missing. Dude, that's cosmetic, man. That doesn't mean anything. You can go all the way FHA that way. So it's things like that I know because I've been doing this 19 years and I know what's going to work, but that's a good cheat sheet. I'm going to definitely do that. I think that will definitely help a lot of people out. So
cool. Okay. So one more question about VAs. 0% down. Is that only for primary residence or how does that work? What if it's a second home?
there's no second homes for VAs. It's
Okay, so it's only for primary, right? Okay, that's a good point to also understand because so if a veteran wants to buy a second home
Yeah.
or a vacation home or whatever, they would have to go another route.
It depends. That's also another gray area. So yeah, it is a primary home. I've had scenarios that they could use per their certificate of eligibility more. It just is going to require possibly 10% down depending on the COE. And if they're relocating for active service, they could potentially have 2 VA loans. It depends. Not
But
within,
the new one has to be their primary residence, right? Okay,
right.
so
There has to be some sort of documentation to paper trail that to say, hey, the active
the
service.
relocation.
Exactly.
Okay. And so also if they're a veteran, they also had to have been discharged with good standing and all that stuff, right? So there's certain documentation that has to be presented just so agents know like the scope. They're not the ones looking at the paperwork, but understanding that part, right?
Yeah, DD 214 honorable discharge and there's
Perfect.
certificate of eligibility to see if they're, you know, what type of disabled, if they're 100% disabled, now they're going to be exempt from taxes and no mortgage insurance at that point. So it's, you know, the funding fee is going to be removed.
Right.
So
That's so that's good. One more thing I want to bring up about VAs is that just because it's 0% down doesn't mean you shouldn't be having escrow. This is a huge misconception that agents are doing and probably making your offers not getting accepted because even if it's 0% down, you still need to have respectable offer presented with a deposit. Okay. Escrow deposit is super important because it tells the seller that you're serious, right? That's the seriousness factor of the offer. Now, what amount that's where you should be knowing more or less like what are the closing costs going to be and you could estimate yourself accordingly based on that and then see what's also in the norm within the community, within the market of that time of how much down you should have. That if you put more down, you get it, and your closing costs are not that much. You will get reimbursed at closing from the closing agent of what wasn't used. So that's a strategy right now in this market. Don't go with 0% down or $1,000 or $500. It ain't happening.
Yeah,
right.
I love that idea. I think that, and I always say that too to the veterans. Look, you should do X down to make it look aggressive and appealing to the listing agent. One more thing too is there's a lot of veterans that will tell the buyer's agent, there's no closing costs. There's nothing. It's 0% down. I don't need an escrow deposit. So then they just go with it. Okay, fine. We'll do 0% down. They're just following the leader. That's incorrect. There's going to be costs. Now, I know there's many companies, and I'll name the names because I'm not going to undermine anyone here. Navy Federal, USAA, these types of VA credit union, the Federal Credit Union, they do hold the portfolio with those notes, and some of them may be able to, if they're 100% disabled, transfer that to a new note. And so therefore we need to, on our end, if we're doing a VA, there has to be escrows collected. So if they're exempt from their taxes per se, we need to collect, then they go to the county and they get, proration back on X. So that's within 30 days. They might be able to transfer it over, they being the other portfolio lender, whoever it is. So there could potentially be zero closing costs.
No, because who's paying? Well, there can be more than 100% financing.
Yes.
Some lenders will wrap up closing costs in the
Yes.
loan. So the
Yeah.
loan amount will be more than the purchase price, and they will finance doc stamps, title insurance, yada, 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 right? Survey, etc.
They
So
do stuff
it's
like that.
not very common. I've probably seen it twice in my 12 years of doing closings,
And
but
that's
it is
really,
possible.
and that's really going down like a variable. So I mean, at the end of the day, there's closing costs and you should put escrows down, 0%
Right.
down. That's it.
I'll say out of all the MBA loans is maybe one or two out of all of them that we've done in 12 years that I've ever had that. I think
Yeah.
it was one from my memory because it just sticks out. You're like, wait, what do you mean? I think you have something wrong. Your loan amount is higher than the purchase price. They're like, no, we're financing the closing costs. I'm like, oh, it's because that was the first time we had handled that. So, so that's VA loans in a nutshell. And just make sure you're even if 100% financing, 110% financing to wrap up closing costs, you're not going to get accepted in this market if you don't have escrow. So that's like the strongest. I think that's the biggest tip. Like, someone asked in the thread about how to get them accepted. That's really what it is, and how to combat that. Now,
There's a question: how do we compete with VA in this market? I'm not certain what that means.
I think that's what we just answered. That's the only way to make your offer more
So just so everyone knows,
sexy. It needs more money down.
guaranteed loan, like that's closing no matter what. Like there's what I mean by that is the certificate of eligibility gives them approval to X. And so a VA with immaculate credit and money in the bank, that's a sure thing. And so I hate to think less that of someone that they're putting 0% down. Oh, is it a low moderate income buyer? It's not. That should be second on the totem pole in my eyes. So cash is king, VA should be second, then third would be conventional. Just because they're doing 20% down, that doesn't mean anything. VAs gives you better interest rates, no mortgage insurance all day long. VA. I mean,
right, you're not going to have that cash to close crunch like you do with other files because there's 0% down. They might even finance the cost, and they really work really hard to get those buyers, those veterans, like able to purchase.
When you run DU, this is really going down the rabbit hole. When you run DU, the likelihood of that, I just had a VA close with an 86% back end debt to income ratio, 86%, $820,000 jumbo VA. So guaranteed, man. I mean, DU gives you it. All right. What are the stipulations and provisions? Is it going to be, insurable on the secondary markets? Conventional, if you move the wrong way and the credit, something happens, goodbye. DU's not going to like it. And that's not guaranteed. So that's really knowing the business. And
so as a listing agent for the listing agent, so it's our job as a community to educate the real estate community. So that's why it's important that we're talking about this.
Yeah.
But as a listing agent, you shouldn't be balking at that. And the reality is the average veteran has a higher credit score and higher, everything compared to in terms of ranking borrowers. We're not supposed to give preference one or the other, but they are stronger as a average. If that makes sense.
There's no reserve requirements. It just DU loves it. And so that's our desktop underwriter is what we pull from. And that is the cream of the crop. VA deals I'll take all day long.
All right, so let's move to FHA. FHA, we already mentioned some property conditions, but let's start from the minimum down payment. Where are we at with that?
Minimum down payment 3.5%.
3.5%. And that the max seller concession is 6, right? Per your chart.
Seller's concession is 6. And what I'm going to say here is 3.5% mortgage insurance. A lot of people discriminate on VA. Okay. Oh God, I don't want to talk about what I'm doing with this whole thing that I'm developing, but this is exactly what we're about to go into. So, and this is why I'm doing it. And we'll go into conventional in just a minute. So FHA, okay, it has a set fixed mortgage insurance. And if they have bad credit, then ideally it needs to go FHA. If you try to swing them in a seller's market, because I know everyone's doing that now, we got to go conventional. They're never going to accept their offer. If they have a bad credit score, their mortgage insurance is going to be through the roof. Even if their DTI works, nobody is going to want a $400 to $500 payment on mortgage insurance. That's going to scare the hell out of them. So if you're scared of the listing agent, you're going to lose a deal. So it's knowing that stuff and really knowing their credit. And so if I'm a buyer's agent, I'm asking, hey, what do you think your credit is? If it's bad, conventional shouldn't be an option at that point, because now your mortgage insurance is going to be through the roof. Oh, but mortgage insurance stays on from the lifetime of the loan, blah, blah, blah. If they're making less than 109,000, it's 100% tax deductible. Number one. Number two, if they put 10% down, it automatically comes off after 11 years. So you could do that option. FHA, 10% down, it's automatically going to come off the MI after 11 years. So that is a really good sweet spot. 10% down FHA, but seller's concessions, yes, the max is 6%.
Awesome. This must be the primary residence, right?
Primary residence, you can purchase, like I'm doing for Jessie Steer and her client, a duplex. They're living in one of them. They're going to rent out the other. They can use that passive income to offset the DTI, because I'm seeing that in the questions right now. The max DTI that we go up to is 56.6. Okay, so can it go above 54, Wanda? Yes, it can. It depends on DU. It depends on DU. And there's now what's called credit layered risk through, running DU. So if you're not getting that approved eligibility, then you gotta see what it likes, what it doesn't like. It's going to give you eventually. You just got to know, how to work the system.
Good stuff. What about property conditions? I don't believe there is a termite inspection requirement for FHA.
4-point really covers all of that. So, if they don't have one, no, it's not mandated. I mean,
it's not mandated.
You
should, but like for the loan, they don't need to see it, is what I'm saying. What about, so it's still under those HUD guidelines that you said for the property conditions on VA will be the same ones for FHA. You need the stove, the garage issue, the bars on the window, right? So we'll get a cheat sheet for you guys on that.
Life expectancy of the roof, 3 or more years, I believe, or 5, something like that. Gosh, that's a refresh one. I think I'm on that 5 or 3.
I think it's 3. I just heard 3 recently.
It's 3.
Okay, good. So that is FHA. Now that takes us to conventional. So conventional can vary, right? And we're going to go back and talk about condos as a separate thing and go through the loans separately in a little bit. We're going to talk about right now, what we've been discussing is primary residence, duplex, a single family home. So with conventional, Anthony, what is the minimum down payment for a single family home?
Okay, so if you're a first-time home buyer, 3% home ready. Okay, if you are not a first-time home buyer, 5%.
Okay. So obviously, if you're under 20% down, there's mortgage insurance, right? Which we were just talking about. So
20% down is the sweet spot. So if you're below 20% down, you're going to get MI. MI will usually come off after 7 years, depends on the market right now. Jesus, the market's crazy. So maybe less than that, depends. And yes, 20% down will eliminate any mortgage insurance. 5 to 10%, your seller's concession is 3% max. This is where everyone gets this wrong. Anything over that, okay, you can go up to 6%, but it's going to be 3% max if you were under that 10% threshold. And what I see a lot.
So let me break that down because I'm not clear on it. If it's under 10%, the max is 3% seller concession. If you do more than 10%, it can go up to 6%.
Correct.
Okay.
Correct. So if you do 11% or 10.5%, whatever it is down, boom, you can go up to 6%.
So these down payments options that you gave for conventional financing, depending if you're first time or otherwise, but they're for primary residence. So if it's a second home, FHA wouldn't apply. Just to scope, you can't do FHA on a second home or investment property, right?
No.
So for conventional, you can, but you need to go 25 or 20.
For conventional, for what? For second home?
Second home or investment, like
10% is minimum.
10% minimum. And then
for investment homes.
For investment homes. Okay. Okay, cool. So I like that. 10% minimum.
And no gifts on investment homes. So
okay.
I know a lot of people screw that up too. They always gift money. Oh, she's gifting us money for the investment. You can't do that. it can come from their account, then you can do something out around the, afterwards. I didn't tell you that, but I mean, that's not,
Yeah.
that you can't do gifts.
You can't do gifts. So excellent. So what I'm doing, Anthony, just so you know, is whatever we're talking about as a category that's
know.
not on your chart, we're gonna have like a master chart.
That's a really good one, man. And there's a lot of one too. There's a couple things that I wrote down that I think we could add. That's good. It's good reference.
Yeah, it's gonna be good. We use it for our team as well, so it's a great tool to have. So that's pretty much. So are there any property conditions
Now, I
for
mean,
conventional?
conventional. I mean, yeah, I mean, it depends. You can't have the place have a hole in the ceiling, and what I see a lot is there's water stains, and you're just asking for an appraiser to step and say, look, there's gonna, might need a roof cert at that point. Is it habitable? I mean, is it structurally sound? Like that, those are things that, you're gonna really catch yourself in a bad position. So if I'm a listing agent, I want to set the property up perfect. If there's some patch up cosmetic work, then yes, I would definitely take care of that. But for the most part, conventional lets you
No
go.
problem.
There's-
Gotcha. Okay. All right. So then what about mortgage insurance does apply if you're less than 20%. We already covered that. You're allowed gift money in conventional, but not if it's a second home. And
no, investment home, second home, you're allowed gift.
investment home. Okay. Cool.
And second home's 10% down or up. You can go as high as that. The seller's concession on a second home is up to 9%. Okay, if there's more than X, which would be 25%. So the more you put down, you can max that baby out. I mean, there's a lot of wiggle room there. I don't see the max that I've ever got was FHA 6% seller's concession. I've never, and in fact, the VA that I was just talking about got the 4%. So he maxed out that concession because there was a couple things with the seawall that needed to be replaced down the road. And we said, all right, let's just do a concession, and he'll do that in 5 years. So that is that concession can be used, guys. There's ways to make that work for your buyer.
Cool. All right. So now that we went through the 4 main types, I do want to just touch on the concept of hard money loans. Like, there are no guidelines on hard money loans. The one thing I will tell you is that you cannot get a hard money loan on a primary residence as a general rule, because of all these federal guidelines and requirements of disclosures. So to get a hard money loan, you must be purchasing in a holding company. And that's how that is. So then when you do that, you can't get homestead exemption, all that stuff, but it is something that's an option there. And that's usually requires the creation of a company. So just so you guys are aware of that, that's the only quirk there, but there are no obviously minimum down, like there's no set guidelines. It just depends on what that hard money lender is going to want. Some of them do have appraisals. Some of them are old school and will just drive by the properties. It just depends on who you're dealing with and like what they want. They usually want 20% down though for hard money. So at least, and then depending on the property type, they might ask for other things. So that's that category. With regards to condos, let's run through
before we go on condos, because I forgot one thing. Investment homes gifts is 2%. This comes up a lot. It's not 3%. I've seen in a lot of scenarios in my past that they had to change the concessions and start really cutting costs, lender costs, or whatever the case is, to make it work. So 2% is your max on an investment conventional home seller's concession.
Good no.
Condos.
Okay, let's go to condos, and then I want to talk about appraisals as well. So with condos and VA loans, they have to be VA approved, right? There's a master list on this already of what's approved.
Yeah.
Okay. So if they're not on this list, can they get a VA loan?
No.
Okay.
You're not touching. Not on a
condo. So if you have a VA who wants to buy a condo, make sure you know what the list has and make sure you're looking at those buildings. And there's more than likely not going to be any of those fancy buildings, right?
You can do a spot unit approval. you're going down a rabbit hole. I've closed 4 of those and I balked at one of them, and that was the last I'm doing of them. I mean, they're very, very difficult loans. And it took us, I think, 30 to 45 days to close. So
Okay. Okay.
if they're
So,
on the approved list, then go for it. I mean, we have 2 condos right now on the approved list. I think with one with Yara at Vilma, I think, and rolling with it. You know, it's approved, it's good. Fannie approved it all day long. You know,
right.
why flip a coin? I just had this conversation with Alberto. Do you do rec leases? No, that's portfolio, man. That's not in our realm. TD Bank, Regions, Fifth Third, City National, and Aventura all day long. Put a couple $100,000 in their bank, they're going to do anything for you. So I mean, that's where you want to go for those types of loans. Portfolio.
We'll talk about portfolio, which we is a great note to, we'll get to that afterwards. Because I do want to talk about what that means. Okay, so that's VA. FHA also has a list. Is it the same list as VA?
Yeah, va.gov. We can
So,
give them the link too.
but the FHA list, is it the same as the VA list?
Yeah, it's HUD. Yeah,
It's
whatever
it's HUD's list basically.
approves FHA is the same thing probably for VA too. So it's the same.
Okay, okay. Sounds good. So if they are approved, then they have the 3.5%. If they're not approved, you have to go to conventional, right? And put more money down.
Correct.
So let's talk about conventional and money down when it's a condo. So if they're not approved, what does that mean? That means that they don't have the budget and the financial standing to meet the requirements of HUD.
Correct.
So then what happens? Fannie Mae. So then what happens to the requirements of that for what type of money down do they need to put?
So then at that point, your SOL out of going anywhere below 25% on a primary home. So in this case, all right, if you do 25%, you see, once the cards are seen by the underwriter, you're really in a situation that they're not going to unsee it and say, all right, give me 25% now. So now I don't want to say anything, but I mean, at the end of the day, it really depends who your underwriter is. If it's insurable and it's good, then go 25%. And if that's the case, because you're talking about budgets and there's not 10% liquidity, then yeah, make that decision at that point. You have to put more than 25, or no, I'm sorry, less than 20. You don't have to put more than 25% if it has 10% reserves. Okay. And we have a whole entire condo episode because I know people are hitting us up with that. And we have a cheat sheet for that, an amazing cheat sheet, and it's copyrighted because it's that badass. I send it to all of my agents. There's a tutorial video on it. And there is a condo formula to educate, not to say, hey, lender, do the numbers for us. You guys can figure out how to add and subtract on your own and do those numbers. You don't need a lender to do that. You should want to know how to do that. And it's important to figure out that formula so you can see if it has 10%. We break it down for you. But I think that answers your question, or no?
Yeah. So 25% down. 25% down is what causes a limited review, right? Versus a full review. So that's a differentiating factor. You want a limited review when the full review is going to show that they're not like qualified for this type of property, right? So they technically could be qualified and not on the list.
Yes. And that is a scenario where you as a lender need to really have a good relationship with your agent. I mean, I had this scenario recently, and I said, look, I respect you as an agent, and I don't want to go down this road, but if you're okay with flipping this coin, I'll roll with it, and we can do that. Oh, but it has 10%. Okay, just because it has 10% liquidity, you still need the full review. There's 33 plus questions in there. One question is off, it's
Right.
done.
So a full review goes into litigation, it goes into reserves, it goes into lawsuits, it goes into insurance. Well, it goes into insurance no matter what, but there's a lot more layers of that. They want to see the types of litigation there is, et cetera, et cetera. So there's a lot more layers. That's the con. So when you hear us talking about the condo questionnaire, that's where you said 32 questions. That's those 32 questions of what's needed about the nitty-gritty background of the financial legal standing of the association as an entity to see if they're basically a risk or not for the lender to invest and be able to sell it later.
Yeah, exactly. And the limited review, if they put 20, if they're doing 25, get the extra 5. Like what I've learned out of 19 years, our name is everything. That's it. That's it. And relationships are everything in this business. So I am going to push for that 5%. If it's gifted or whatever the case is, because I want a sure thing. I don't want a coin toss. That sucks. And then you watch, oh, everything's great, Anthony. No, I'll still love you if it goes sour. Sure. Once it goes sour, that's the end of that relationship. So, it's a difficult loan to close. I'm not saying it's impossible. We've done it many times, but it's hard. I would say take a proactive approach, do your due diligence, and get the budget up front every single time. And if you can have it go through a third-party questionnaire and get that condo approved prior, I know that's impossible pretty much in this market with sellers, grabbing stuff off the market. But I mean,
but the condo market's not the same as the single family home market. It's not the same. As a listing agent, you should have the budget and these financial information that are needed to get a borrower pre-approved for your building on the MLS as an attachment. That is like the money move right there.
Exactly. If I was a listing agent, God, maybe I should be a listing agent. I
know, right? Like sometimes I'm doing the wrong part, but it's okay.
I would call my lender and I would say, all right, seller, we're going to have this guy go through the condo association third-party vendor, which we have. Lender takes it through them. They approve it. You're done. Now you know it's approved. You get SARS approved. I'm sorry, not SARS approved. If you get the condo association approved, you're going to get every damn listing in that place. You know what I mean? And that's expensive. It's like, I think it's like 10 grand to get the association approved with Fannie Mae, but the association should want to do that. Financing's good to be, in a condo complex. We've spoken to the board of directors in some cases. I know my ops manager went on a meeting when they were having the meeting to make sure the budget was going to be good for 2020 last year.
That's a whole other level of trying to get stuff accomplished. When your lender is going to a budget meeting.
And Adam is crazy like that. And he did that. And
I can't believe he did that. I think that was my deal too, from what I remember. So
he spoke to the whole entire unit. They made it work. And they loved him for it because now the place can do financing. And it's a small place. I think it was like 12 units, but still,
amazing.
That's what it takes.
I love it. I love it. Okay. So we talked about condos. We ran through the different types. I want to talk about appraisals for a second. The condo, the FHAVA rider that needs to be added to your contract when it's an FHAVA loan specifically already includes a appraisal contingency in there. The buyers can proceed with a lower appraisal and put more money down if they want. However, they cannot be forced due to that contingency in that document. Now, and there's no deadline or timeframes on that contingency there. Whereas if you're going to do conventional financing, you should have an appraisal contingency, which does have the deadlines built in 10 days before closing as the default. So making sure that that's included in there. Now, as a listing agent, you want to front load your appraisal and deal with issues up front and not have to renegotiate 100 times. If I was a listing agent, that's what I would be doing with my offers is not keeping the default on there. Do you have any other comments on appraisals, Anthony?
If I'm a listing agent, like I said, I am going to do everything in my power to make sure that the place is spick and span. I've seen water stains, like I said, that just, it's why not get a handyman to go paint the damn water stains if they just replace the roof?
That
It's,
happened to me. That happened by the house I purchased. They
it's
fixed
just,
the roof and they never painted the roof. They never painted the ceiling and there was water stains. So when we did it, I was like, listen, are you sure this is not a new or old thing? Like, how do I know?
it's just, it's like
Bad marketing.
awful. Out of mind, out of sight.
Lazy,
la-
lazy for the sellers in this scenario because
Lazy.
it's not
And
good.
just, and if they want a smoother close in, oh, the lenders, blah, they're picking apart the file. Because dude, there's a water stain up there. So there's a lot of things, and the pools, should be shocked before the guy goes out there. The electric should be on. Some of the cases I've seen, if they're not on, so now they got to go back out for a final inspection. That should be a cheat sheet right there, what it takes. The plumbing needs to be on. The AC needs to be functional if you're doing an FHA loan. These are things that they're going to look for. So if they're not done prior to the inspection, and I'm a buyer's agent, I don't want the appraiser going out there, because guess who's going to pay? We pay for the final inspection walkthrough, because I'm not having a buyer pay $150. Other lenders, they don't give a shit. They're going to, no, it's $150. Now my problem, that's off. That's the buyer's agent's problem. That's the inspector's problem. The appraiser can't turn on or off, the water. Legally, they're not supposed to do that stuff. They're not there to be an electrician. They're there to appraise the property. So there's a lot of things that go into play. And I think that would also be a good reference point too. So that way, like a 12-point checklist or something like that, that'd be cool. That's what we
I like
should.
that. So I want to bring up, we mentioned it briefly already, a portfolio loan. So a portfolio loan, I don't know if there's a formal definition, but it's basically something that cannot be sold in the secondary market, which means that it does not fit within the VA FHA conventional guidelines because of something. And that the number one thing, the most common thing we see, you'll see it for condos a lot. For portfolio lenders, will have different rules. 55 and over community, that's a portfolio loan. And anything else you want to add on those?
He who holds the gold makes the rules, and
Right.
they make the rules, and they're going to do anything in their power to get that for either wealth management or for service and rights.
So think about it. Basically, they're not selling it later. They're going to hold it. So it's smaller banks that will hold. Maybe it's sold later, but the idea is that it's not going to be sold to the federal government.
Yeah.
Okay.
Yeah.
So it doesn't fit within the federal government's framework. It's different for whatever reason. And they're accepting that risk. They're okay with that. That might change your pricing or your structure, but that's what it is. And definitely it's going to take longer because banks take forever.
I wouldn't use a bank. I mean, I just told the gentleman, I said, look, I'd be doing you a disservice by doing that. I can broker it out, but why is the guy going to pay for that? You can go straight over here, across the street, and get a much better deal. I'm not afraid to admit that. You know what I mean? That's not our forte. That's not what we focus on. So it's just knowing that type of stuff. If there's a rec lease involved, that's portfolio. That's not happening anywhere else. There's no way that's closing unless and if there's litigation and craziness going on, and that might be non-QM, that someone's going to really take,
That's another cheat sheet, Anthony.
Yeah.
What requires a portfolio loan? Putting all these things just so agents know, oh, this is a 55 and over community. And my client saying I'm pre-approved by whoever, PRMG or this or that. That's they didn't tell them that missing link. So we have a closing. There was the rider there, 55 and over rider, and after the third extension, oh, I forgot, we didn't have. Sorry, we didn't know it was a 55 and over. It's on the contract.
It's so bad, man. Yeah, you know what? I think maybe we should do that. I've got all my cheat sheets and DC's cheat sheets all centralized, but I'm thinking we'll definitely do that because
let's do a little revamp. It might not come out tomorrow, but it's going to be a really good revamp of this loan cheat sheet. I'm going to get involved and make sure we're going to add some contractual things to make sure that these extra tweaks are being added about appraisals and things like that. It's going to be a really good one, guys. So the idea of today is not to keep this all in your head. We just want to open your mind to the different things you got to consider, and you'll be getting the cheat sheet after the show in a couple of days, and you'll be able to have that as a reference, laminate it, save it, star it in your wherever, however you keep your
I have
references.
it framed in our office, and the girls go there all the time and they use it as a reference. I mean, I've memorized most of it, but you know, it's
No,
good.
but that's the thing, that we're like, myself included, I don't work in loans every day the way you do. So to keep that in my mind is not the same as, like, it doesn't happen, right? I know other things, like I could spit out other things about the contract or this or that. So but sometimes there is and there always will be an overlap of our three roles, right? So lending, title, contracts, and realtors, like, we have a natural synergy that everyone needs to understand everybody else,
Yeah,
to
communication.
communicate and understand the roles and the guidelines to be able to better do your role, because they interplay,
Yeah, and
right?
that's hard to it's hard because, oh, well, the client said they can do it. Why can they do it and you can't do it? It's that back and forth. A cheat sheet and a reference point, here, show them this. You know how many times I've sent the buyer's agent our condo cheat sheet template that's emailed? The buyer's agent emails it to the client and it's a whole tutorial. Then the client gets it. They're like, oh, that makes sense. It's out of state. I get it. In Florida, it's different. Thank you. So, and
Yes.
they even send it to the lender, and the lender, if it's a big box bank that doesn't know Florida, at all, they're going to say, oh, he's right. Sorry, you're our underwriter. So it's just good to be proactive.
It's good to have it. Look, at the end of the day, of course, we look out for you guys in the deals we work on, but we know we can't get them all for one reason or another. And sometimes when I'm working with banks, they don't know because their underwriter and their processing is not in Florida. They don't understand Florida. And I need to, as a title attorney, educate the lender from another state about how loans happen in Florida. That's why it's important for us to understand and, like, be aware and familiar with the other departments, right, of the closing process, to make sure, listen, obviously for we need to do this for our clients, right? But at the end of the day, we're also doing it for our liquidity, right? We need to get paid. We only get paid at closing. We don't get paid if we don't close. And if someone else is not doing your job properly, or if saying they could do something that really can't be done because they don't know for one reason or another, and you have enough knowledge because you educate yourself and you work closely with the other partners to be able to have that information, you will be a rock star, not only for your clients, but you will make sure you get paid when you're supposed to get paid. Listen, I'm telling you,
you're wasting time, man. You're playing tour guide.
there's nothing worse than wasting time. And at the end of the day, it is what it is. And it happens. It's a natural part of our business. Unfortunately, sometimes deals do get canceled, or you have to get another property, or you have to find another this or that. But sometimes you can avoid it. And that's part of damage control. That's why damage control was created, is let's prevent it before it even happens, right? All right, guys, that was an awesome episode. I know it was nitty gritty and detailed and technical, but you're going to get your cheat sheet as your reference. Use it, refer to it, call us if you need us. And remember, it's a free show. Share the show.
Share the show.
Have an awesome day, guys.
Thank you.
Bye.